Welcome to Talk Tickers. Today, we're tackling a real head-scratcher, Phreesia's latest earnings report. Now, on paper, they absolutely knocked it out of the park. A huge beat on profit. You'd think the stock would fly, right? Well, it did the exact opposite. It tanked. So what in the world happened? Let's get into it.
So, if you just looked at the headlines, everything seemed incredible. The company posted an adjusted earnings of 10 cents a share. Now, to put that in perspective, Wall Street, well, they were expecting a loss of 1 cent. So this wasn't just a little beat. This was a complete and total blowout.
And yet, the market's reaction? Absolutely brutal. The stock just fell off a cliff, losing almost a quarter of its value overnight and hitting a new 52-week low. So you have to ask yourself, how does a huge earnings beat lead to a stock getting crushed? What were investors seeing that the rest of us missed in those headline numbers?
All right, let's start with the quarter itself, the raw numbers. Because to really get this disconnect, you have to see just how good things looked on the surface.
Okay, just look at these numbers. Revenue, up a healthy 13%. They actually made a real GAAP-audited profit for the second quarter in a row. That's a huge deal for a company like this. And check out that operating leverage. Their adjusted EBITDA margin jumped to an all-time high of 24%. I mean, everything you'd want to see. Free cash flow is surging. It all looked fantastic.
Now, as you'd expect, management was feeling pretty good on the earnings call. They weren't just taking a victory lap, though. They were painting a picture of where the company is headed long-term.
So their growth story really boils down to a few key things. First, they just spent $160 million to buy a company called AccessOne, getting them into patient financing. That's a big move. Then you've got new tech rollouts like Voice AI, plus a big push into marketing to healthcare professionals. The whole idea is to keep that revenue growing in the mid-teens while making more and more profit along the way. Sounds great, right?
Okay, so we have strong results and what sounds like a solid plan for the future. So I'll ask again, why did the stock get hammered? Well, this is where we need to look past the shiny headlines. The market dug into the details and found a few things it really didn't like.
And here's red flag number one. The CFO comes out and says they want it to be, and I quote, a bit more measured on network solutions. Now you have to understand, network solutions is their golden goose. It's their fastest growing, most profitable part of the business. So when you hear the word measured about your star player, yeah, that's a problem.
So that comment about being more measured really started to unravel the story for investors. It hints at things like tighter pharma budgets or maybe some regulatory headwinds. But that was just the beginning. The market also got spooked by the details in the company's forecast and some major questions around that big acquisition they just made. And this is where some sharp investors did some back-of-the-napkin math. See, Phreesia raised their full-year revenue forecast. Great, but wait a second. That new company they bought, AccessOne, is supposed to bring in about $7.5 million in the next quarter, but they only raised the total guidance by $3 million. You see the problem? That means they quietly lowered the forecast for their core business by about $4.5 million. That's what we call a stealth guide down, and investors hate it.
The other big issue? It all comes down to that AccessOne deal. It has basically turned Phreesia into what Wall Street calls a show-me story. The market is basically saying, yeah, we've heard your promises. Now go out and prove it. We're not giving you credit for anything until we see the results.
And here's why they're so skeptical. First, Phreesia took on $110 million in new debt to pay for this thing. But here's the real kicker. Management straight up admitted on the call that the AccessOne product is, and I'm quoting here, not suited for the vast majority of their current customers. It needs a ton of work and investment before they can even think about selling it to their existing client base. Ouch.
So you really have two completely different stories playing out here. On one hand, you've got management's bull case. We're profitable, we've got these amazing new ways to grow, the future is bright. But on the other hand, you've got the market's bear case, which is all about the here and now. Your main business is slowing down, you just took on a bunch of debt, and this new company you bought is a huge integration risk. Two totally opposite narratives.
All right, so with those two competing stories on the table, what's our take? Where does this stock go from here? It's time for our call on Phreesia.
So what's the verdict? Look, for the next few quarters, we think this stock is going to be stuck in the mud. It's firmly in the penalty box. Investors are going to want to see two things. One, they need to deal with that new debt. And two, and this is the big one, they have to prove they can get their core business growing again while making this messy AccessOne integration work. Until we see real proof on both of those fronts, the stock probably isn't going anywhere fast.
Which brings us to our official rating, Market Perform. Here's the bottom line. The company is making real money now.
and that profitability should put a floor under the stock. It probably won't completely collapse. But all of this uncertainty around their growth plan is going to act like a ceiling, capping how high it can go. So it all boils down to one question. Can management pull off this tricky integration and get their main business firing on all cylinders again? The answer to that is going to tell us if this is just a bump in the road or the start of a much bigger problem.
We'll definitely be keeping a close eye on this one. And as always, a quick reminder, this is not financial advice.